Hello and welcome to Financial Intelligence. In this video, I want to talk about an interesting way of generating passive income, which is through investing in JEPI. JEPI is the JPMorgan's Equity Premium Income ETF. It is designed to provide monthly income while maintaining prospects for capital appreciation. In the rest of this video, I'm going to explain how JEPI operates and discuss its advantages and disadvantages. If you like the type of content that I provide, subscribe to this channel and give this video a thumbs up, and also hit the notification bell so that you won't miss any of my future videos. What is JEPI? JEPI is an ETF consisting of US large cap stock portfolio paired with call option writing strategy to earn additional income. In other words, JEPI generates income through selling options on US large cap stocks. What are call options? Options are financial contracts that give the option buyer the right but not the obligation to buy a stock at a specific price within a specific time period. If you think that a certain stock is going to go up by a certain date, you can bet on that movement using options. Options essentially are a way to increase your leverage. An option buyer profits greatly when they correctly guess the timing and the direction of the price movement of the underlying asset. If the option buyer is wrong about the direction or the timing, they will lose their premium, which was the price they had paid to purchase the option contract. Buying options is very similar to buying lottery tickets. Your odds of winning are low, but if you win, you will win big. JEPI's strategy is essentially to benefit from the tendency of some investors to gamble by buying options. The thought process is that most options expire worthless and their buyers lose the premium they had paid to purchase them. Therefore, JEPI is an actively managed fund that generates income by selling options on US large cap stocks. JEPI focuses on US large cap stocks because they have low volatility compared to other stocks, which means that their call options are more likely to expire worthless, allowing the premium seller, JEPI in this case, to collect the premium. JEPI's advantages. The first advantage of JEPI is that it is trying to ride the new wave of gambling / day trading in the stock market. Day trading has become very popular worldwide since the onset of the coronavirus pandemic. TD Ameritrade reports that visits to its website have nearly quadrupled since the start of the pandemic. Meanwhile, trading apps like Robinhood are seeing a significant surge in option trading. Overall, there are many people out there day trading using options, which means that there is a lot of money to be made selling options. That is particularly true because option premiums have gone up noticeably because of the elevated market volatility. The second advantage of JEPI is that it provides an income solution for today's market environment. Income investors face a tough choice: either hold cash and core bonds paying low rates, or reach out to higher yielding markets with more risk and less liquidity. JEPI helps generate a steady monthly income stream while being more liquid compared to other types of passive income streams, such as owning rental investment properties. The third advantage of JEPI is that it gives investors exposure to the upward trending markets while creating additional monthly income. Most stock markets are rising due to the excessive liquidity pumped into the markets by central banks. JEPI allows investors to benefit from these upward trends in the markets because the fund invests at least 80% of its assets in stocks. In fact, one of JEPI's primary goals is to deliver a significant portion of the returns associated with the S&P 500 index with less volatility. JEPI's disadvantages. JEPI has paid a distribution yield of 7.6% over the last 12 months with relatively low volatility since its recent inception in May 2020. These are exceptionally high numbers. However, one of the disadvantages of JEPI is that it is a very new ETF and it does not have a long proven track record of success. It remains to be seen if they can keep up delivering yields higher than other alternatives. Another related disadvantage is that JEPI's model works well when the stock market volatility is elevated. Higher market volatility means that more expensive option premiums can be sold, which translates into higher monthly income for JEPI investors. The monthly income levels tend to drop when the market volatility is subdued. The last disadvantage of JEPI is that it is an actively managed ETF, which means that the fund has hired an experienced equity management team to run the operations. Therefore, JEPI has a higher expense ratio compared to passive ETFs. JEPI's management fee is 0.35%. I hope that you liked this video. If you have any recommendation or suggestion, add them in the comment section below. Don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you won't miss any of my future videos. Thank you and take care.